Dhiraj Agarwal joins us, Managing Director with Ambit Investment Managers. Dhiraj, good morning. Thank you for joining us. Dhiraj, I'm looking at the trade setup for Indian markets and for US markets. While Indian markets are holding on nicely, US markets is where the real strength is. Despite all the tariff concerns, despite debt concerns, despite the concerns which were centered around what will happen to immigration law, US markets have made a remarkable comeback. Why is that?
So at this point of time, I read a very interesting article in the last weekend's Economist. It was titled, the new buzzword apparently in the market is nothing ever happens. So the article basically says that most of the large mega macro and geopolitical events have absolutely had no impact on the markets. And the markets are just focused on bottom-up stories, markets are just focused on earnings, and markets are just focused on funds flow at this point of time. We have seen this before. We have seen many times before in one phase of the market tends to ignore all negative macro news, all negative geopolitical news, and it continues for a while more. Maybe we are in that phase that markets are ignoring some of the negatives, and this will eventually come to bite. Or on a more optimistic note, maybe the negatives will wash itself away at some point of time. So even in the Indian context, the earnings have been weak, right? The March quarter earnings have been very weak. Last 4 quarters earnings have been weak. The markets have bounced just right back, just a shade away from all-time highs, because markets are looking forward. We are hoping and expecting that second half there will be a strong recovery going into FY27 as well, although first half looks like a little bit of a washout. So at this point of time, investors are taking a longer-term view and ignoring the short-term stress.
So what's a prudent strategy right now? When you know that earnings are not there, the grain of the truth is whether it will come back or not, I don't know. Today they are not there and markets have gone up. Should one exercise caution or wait for a better tomorrow?
No, this question has 2 answers. So one is at the index level, one is at the stock level or the company level. So at the index level, I think at these levels, one should be slightly cautious. Whether the upside is there, large, small, in momentum, etc., one should be slightly cautious. But at the company level, the interesting observation is that markets are seeing a huge amount of polarization in performance and stock prices, which is in turn driven by polarization in earnings. So let's say the Nifty earnings last year was about 7% YOY, but there is a bunch of companies growing at 15 to 20, and there's a bunch of companies not able to grow or even decline in earnings. So this is a great stock pickers market. One can find ideas of companies and make a portfolio of companies which have market beating and sector beating earnings growth, and that space is doing well, and I think may continue to do
well. We have a bit of a interesting patch where flows are strong and supply is also strong.
That's right.
Where will the equilibrium, if I may use the word, will settle? Will supply start reducing or will demand start coming back?
Liquidity flows, both sides are impossible to predict, right? So it's a $1 million question. But at this point of time, if the market continues to be buoyant the way it is, I will not be surprised if the mutual fund inflows, which has dropped down from 40,000-50,000 crores per month average down to about 20,000-25,000 crores right now, climb back to 40,000-45,000. And supply is there, but I think on an aggregate level this year, the supply will be lesser than what it was last year. Last year was massive. FY25, give or take about $60-65 million of total supply. If you add all kinds of supply, including primary and secondary put together, I think it will be a bit lesser this year.
Okay. Where are you picking your spots in terms of what could be called as reasonable and fairly priced, but earnings will surprise us? What is that criteria? What is that group for you?
In terms of sectors, in terms of stocks?
Sorry. I'll keep it open. I would love to hear stocks. Why not? Let's give it a shot.
Yeah, I typically don't comment on stocks, but I think what's happening at this point of time is that within every single sector, you're finding few companies which are earnings outliers and few companies which are not able to grow very, very strongly. So I will just illustrate that with an example. So if you see IT, for example, there is a bunch of second liners. They're no longer mid caps. I think they're fairly large caps. Second liners names which are delivering on strong earnings growth like Persistent, Coforge, etc. The stocks have done significantly better than the mega caps, which is, let's say, Infosys and TCS, where earnings growth are now sub 10%. We are seeing that in banking as well. There's a massive rotation which is happening. Last 3 or 4 years belong to PSU banks and the private banks underperformed. We are seeing a massive rotation this year back into private banks and PSU banks under a slight amount of struggle. And the macro thesis for that is that whenever economies slow down, whenever credit growth slows down, private banks tend to do better on business metrics, on valuations, and on stock prices as compared to PSU banks. And PSU banks tend to do a lot better when the economy is very, very strong and it's easy to do business. So we are seeing a lot of dispersion in fundamental performance and stock price performance within the sector, and I don't think that will change for the next year or two.
Hi, good morning, Dhiraj. This is Shrishti also joining in. You did talk about the sectors, but any stock that you can touch upon, and also on the part of your take on the banking space, I just wanted to touch upon the microfinance institutions, because within financials now, even a lot of these companies are coming forward and highlighting and talking about that in the next 2 quarters they are looking forward to better numbers, better industry growth outlook, and some of the issues with respect to their balance sheet should be aside by then. Give us your sense. Do you believe in this particular story?
Yeah, I think microfinance is bottoming out and it's turning around. That's what our house view at this point of time is. Banking in general is looking fairly solid because there is just no NPL stress. So banking comes under problems only when there is a rising credit cost or NPL stress. There are no signs of that right now. The pressure on banking a little bit is coming from the fact that the credit growth for the system has declined from 15 to 17% run rate down to almost 10%. I mean, there is hopes and expectation that this picks up in the second half of this year. But if the credit growth doesn't pick up, then the earnings growth remains tepid and the banks might just range straight. But I don't see any risk or an issue there. And there are fairly solid reasons to believe that second half there could be and should be economic turnaround, better economic activity, as well as and hence a pickup in the credit rate. There is a lot lined on the capex front from the private sector. This whole uncertainty on tariffs and trade deals, etc., will completely go away, hopefully by mid-July, early July, or if it drags on a little bit, at least by the end of first half. And uncertainty going away is always better for companies to restart their project plans. So the plans are already there; they're not getting commissioned. As soon as these uncertainties fade, the project plans restart in the economy and the credit growth starts to rebound. So fairly optimistic from a longer term point of view.
Optimistic on the long term. Dhiraj, hi, morning. Last time we interacted, your stance or your strategy was ignore valuations at the moment and look at earnings. Now that we are past that Q4 earnings mark where it's not been all that bad, and in the last 6 months we've seen markets swinging in both directions. This strategy, do you believe this still continues, or now you have a different approach to stock picking or sector picking?
No, I'll be surprised if I said ignore valuations, because I never say that. So I think one has to be cognizant of valuations. Maybe I said it in the context of polarization, which is happening. So whenever the investable universe starts to shrink, which is only a smaller percentage of companies, let's say 30% or 40%, 30% of 1/3 of the companies are able to deliver fantastic earnings numbers, the entire liquidity tends to shift towards that particular end of the spectrum. And that's what sometimes drives valuations to astronomical levels. And we saw that between 2015 to 20. When the investable universe really shrank, it just came down to literally consumer companies and private sector banks, and not even all private sector banks, just a few private sector banks. And we saw valuations in a number of these stocks go to levels because of which there was a 3-4 year consolidation post 2020 and absolutely no price performance. right? So it can happen again if the polarization continues for a bit longer. And maybe in that context, I would have mentioned that uh, because there is difficulty in bulk of the companies delivering solid earnings growth, the few companies which are outliers, valuations might not matter in the near term.
Somebody is looking at, let's say, taking a 3-year view. Is it possible to, or do you think there is a difficult chance of getting a double-digit return, or it's a reasonable probability that if the starting point is today, the CAGR over the next 3 years could be 12 to 15%?
I think at the index level, honestly, difficult to get 10% plus. At a portfolio level, it should be possible.
Portfolio level, if one has to make a portfolio, let's talk about some of these powerful themes. Some are calling it narrative, some are calling it future themes, some are calling it the next wave. EV, solar, drone, AI. These are popular themes, not only in India but globally also. What do you like within these 3-4 themes?
So these are all long-term structural trends, right? So I think, for example, defense. I mean, defense spending is a long-term structural trend. I just read this morning that NATO has finally agreed to increase the defense spending to 5% of GDP. And this was under 2% before this entire geopolitical mess started to happen. So under 2% to 5% is a huge jump. That theme, I think, continues. Renewable energy, solar, etc. That theme also continues. So these, in terms of businesses, some of these are structural 5 to 10-year trends, and I don't see too much of risk in this trend getting stalled or upset over the next few years, including energy. I mean, India is very close to being very finely balanced on the electricity production and consumption side. So we need more investments. We haven't invested enough in electricity generation in the last 15 years. Those investments also need to go in. So while the business trends are secular and more long-term in nature, in terms of converting it into stock ideas, one then will have to pick and choose which companies are able to participate in a smart way, deliver earnings without diluting ROC and ROE, and where the valuations are also in a range where one should be buying. So stock picking and sector trends might be slightly two different cups of tea.
All right, Dhiraj, with this, we let you go on that. Thank you so much for taking the time out and speaking with us and giving us a sense that what are you making of the market moves right now. But with this, viewers, let's move on and let's put the spotlight on the power space, because this